You've been watching mortgage rates for months, maybe longer. Every time they inch up, you wonder if you've missed your window. And every time they tick down, you think maybe I should wait just a little longer. And I get it. The difference between a 6.3% and a 5.9% sounds like it should matter. It sounds like a savings of $116 a month. It sounds like patience paying off. But here's the thing that nobody tells you. While you're waiting for that rate to drop, life doesn't pause. It keeps on moving. And in the Southwest Valley right now, the market is giving buyers something it almost never gives: room to negotiate. That window doesn't stay open forever. Let me show you exactly what's happening. So here's the direct answer to the question that you came here with. 30-year fixed rates are running at 6.3% right now, based on Freddie Mac and Bankrate data from mid-March 2026. But in the Southwest Valley, Buckeye, Goodyear, Avondale, Tolleson, home prices in the $400,000 to $500,000 range have dropped 3.6% year over year, according to Arizona MLS data. That means the home you want costs less today than it did 12 months ago. And here's the piece most people are missing. Sellers in this market are sitting on homes for 78 days on average. They are motivated. That motivation translates into negotiating power for you, specifically in seller concessions you can use to buy down your rate or fund a 2-1 buy down that gets your effective rate down to 4.3% in year one. That math changes when you put those two things together. That's what we're going to walk through today. And if you're finding this helpful, hit subscribe. I put out videos like this regularly, all focused on what's actually happening in the Phoenix and West Valley markets. Real data, real solutions, no fluff. Let me tell you what the generic conversation leaves out. Everyone talks about rates as if they exist in a vacuum. Wait for 5.9%. Sounds like a plan, but it's actually a bet. You're betting the rates will hit that number. You're betting they'll hit it before prices start to climb again. You're betting that your financial situation will look exactly the same when they do. And you're betting that the sellers in the neighborhoods you actually want will still be motivated to negotiate. That last one is the one that people don't think about enough. Right now, inventory in the Southwest Valley is sitting. Days on market are up 8.3% year over year. Sellers know it. That gives you leverage, not just on price, but on terms, on closing costs, on buy downs, on things that actually reduce what you pay every single month. When rates drop, buyers who have been sitting on the sidelines come back. That leverage disappears. When I sit down with families, we don't lead with interest rates. We lead with the ideal monthly payment and what that buys them in the neighborhoods they actually want. Once we find the home, I show them how to use a seller credit, not just for closing costs, but for rate buy down. This shift often increases their affordability by thousands of dollars, turning a maybe into a yes without stretching their budget. Let me show you what the numbers are actually saying. According to Arizona MLS, price per square foot in the $400,000 to $500,000 range across the Southwest Valley is running at about $214.80 as of February 2026. That's down 3.6% year over year. On a $450,000 home, that's a real difference from what you would have been paying 12 months ago. At the same time, median days on market in this area is 78 days, up 8.3% from last year. Sellers are not flying off the market. They are waiting and waiting. Motivated sellers are negotiating sellers. Now, here's where the 2-1 buy down math comes in. On a base rate of 6.3%, a 2-1 buy down gives you 4.3% in year one and 5.3% in year two. The cost to fund that buy down comes from a prepaid account typically funded by the sellers as a concession. Inventory in the Southwest Valley is sitting longer, and sellers are moving towards concession over price cuts. I'm seeing much more success asking for $10,000 in credit to fund a buy down than asking for a $10,000 price reduction. Why? Because it solves the buyer's immediate monthly cash flow fear, which a small price cut doesn't touch. How much does waiting for a lower mortgage rate actually save me per month? That is a question I get a lot. Let's put a real number on the wait strategy. If rates go from 6.3 to 5.9% on a $450,000 loan, your monthly principal and interest payment drops by roughly $116 a month. That's real money over time. But here's what that calculation doesn't include: how long you wait, what happens to home prices while you're waiting, and whether the sellers who are negotiating today are still at the table. The forecasts for national home prices in 2026 are sitting between 1% to 2.2% appreciation. Fannie Mae is at 1.1%, Redfin at 1%, Realtor.com at 2.2%. Even at the low end, that moves the purchase price on a $450,000 home by $4,500 to $9,900. The $116 monthly savings from a rate drop of 0.4% pays back in roughly 3 years. A price increase starts working against you from day one. What is a 2-1 buy down, and can a seller pay for it? A 2-1 buy down is a financing structure where your rate is temporarily reduced by 2% in year 1, by 1% in year 2, and then it returns to your base rate in year 3. On a 6.3% base rate, that looks like 4.3% in year 1 and 5.3% in year 2. The cost to fund that buy down comes from a prepaid account, typically funded by the seller as a concession. Here's why this works in the current Southwest Valley market. Sellers are already offering concessions. Instead of taking a $10,000 closing cost credit, you redirect it to fund a buy down. The seller net is the same. Your year 1 monthly payment drops by roughly $560 a month on a 2-1 buy down. That's not a small number. That's real breathing room in the first 2 years while you settle into your home. New construction builders in Buckeye and Goodyear are offering rate incentives that can go significantly below market rate. I've seen buy downs into the 3% range, even lower, when builders are motivated to move inventory. Resale sellers are competing with that, and they know it. What happens to my ability to qualify for a home if I wait 6 months for better rates or circumstances? The short answer to this is you would think things would get better, but the reality is life will keep lifing. This is the one that I really want you to hear, because this is the conversation most people wish they'd had sooner. Here's a situation that I see all the time. Someone qualifies today, the income is there, the credit is there, everything seems to line up, but the timing doesn't feel perfect yet. Maybe they're waiting for rates to come down a little bit more. Maybe they want to save for a bigger down payment. Maybe a job situation is about to improve and they want to wait until that settles. So they wait, which makes sense. On paper, the plan seems solid. But here's what I've learned from doing this long enough. While you're waiting for your circumstances to get better, life doesn't wait with you. The car breaks down and now there's a new loan on your credit at 2026 prices. Your debt to income ratio shifts. The same income that qualified you for that home you wanted last month now qualifies you for something smaller. Or your company restructures and your income looks different on paper to a lender now. A medical bill shows up. Your family situation changes and your expenses are changed in ways that you didn't plan for. That's what I mean when I say life will keep lifing. It's just the reality of what I've watched happen to people who were in a perfect position and just needed a little more time. If you qualify for a home today, real consideration should be given to that. It may never feel like the perfect time, and that's okay. Buying a home is a big deal, and it comes with big emotions. The decision to move forward will always feel big. There will always be a reason to wait just a little bit longer. But that perfect position where everything lines up the way it does right now may or may not last. The variables you can control right now are the entry price, the terms you negotiate, and the rate you start with. What you cannot control is what rates do in the future, what prices do, and what life hands you between now and when you finally feel ready. If the numbers work today, that's not a small thing. This is the one variable you can actually count on. Should I buy a new construction or resale in Buckeye or Goodyear right now? Both markets are worth looking at, and they have different dynamics right now. New construction builders in Buckeye and Goodyear are competing hard. They're offering rate incentives through their preferred lenders, buy downs that can go well below the market rate. I've seen rates as low as 3.75%, even lower from builders looking to move inventory. That's meaningful, but those incentives are tied to the builder's preferred lender, which means you're giving up rate shopping in exchange for the buy down. Worth understanding before you commit. On the resale side, you have more flexibility. You can negotiate seller concessions and bring them to any lender you choose. Days on market at 78 days means you have time to think, to inspect, and time to negotiate without feeling rushed. Neither answer is universally right. What matters is what stage of life you're in and whether you need predictability of new construction or the flexibility of resale. How do I know if a seller in Buckeye or Goodyear will agree to pay for a buy down? The way I approach this with buyers is straightforward. We look at how long the home has been sitting on the market. We look at the price per square foot relative to the neighborhood, and we look at whether the seller has already reduced the list price. If a home has been sitting for 60 plus days with a price reduction, that may be a motivated seller. May not be, but it may be. A concession request that solves their buyer's payment problem is far easier for them to say yes to than a straight out price cut. Here's the thing I tell buyers: $10,000 in a price cut reduces your mortgage payment by about $60 a month. That same $10,000 used for a buy down or to lower your interest rate can drop your payment significantly, anywhere from $116 to $560 a month. Same money to the seller, completely different outcome for you. We frame the request that way. It works. What if rates actually drop to 5.9%? Can I refinance? Yes, and this is a real strategy. You buy at today's prices with today's concessions, secure the buy down for year 1 and year 2, and then you refinance it if rates do reach a level that makes it worth the cost. The old saying in real estate financing is date the rate, marry the house. The price you pay is locked in at purchase. The rate can be adjusted later. The home appreciation or the price you paid when sellers were negotiating doesn't come back. What I caution you against is counting on that refinance though. Plan for it if it happens. Don't build your budget around the assumption that it will. Rates spent years above 7% in the 1980s. Nobody predicted 3% in 2020. We plan around what we know today. Is the Southwest Valley a buyer's market right now? For move-up buyers in the $400,000 to $500,000 range, this is as close to a buyer's window as we've seen in the Southwest Valley in several years. Prices are down year over year. Days on market are up. Sellers are negotiating. Builder incentives are real and significant. The crowd that returns when rates drop hasn't returned yet. The combination won't last indefinitely. When the rate environment shifts and buyers who have been sitting on the sidelines re-enter the market, the current window closes. We can't predict when, but we can see clearly that today the conditions favor a prepared buyer. Here's what I want you to watch out for, and this is the part most agents won't slow down enough to say. The rate comparison you're doing in your head, 6.3% versus 5.9%, is real math, but it's incomplete math. It assumes everything else stays the same while you wait. The price stays the same. Your income stays the same. Your debt stays the same. The seller's motivation stays the same. None of those things are guaranteed. You will always have a housing cost, whether it's a mortgage or it's rent. That cost exists. The question isn't whether you can afford to buy. The question is whether today's terms with this price These concessions and this buy down create a better monthly situation than waiting for an uncertain future. For most of the families I work with in Buckeye, Goodyear, or across the West Valley right now, when we run the actual numbers side by side, the answer surprises them. Run the numbers before you decide to wait. If this video made you realize there are more variables in the decision than you are tracking, that's exactly the conversation I sit down and have with buyers before they make a move. I'll pull out the current concession data for the neighborhood you're looking at. I'll show you the actual buy down math on the price ranges you're considering, and we'll map out what your monthly payment looks like under 3 possible scenarios. Buy now with a buy down, wait 6 months, and wait a year. Not so you'll feel pressured, so you can make the decision with full picture. If any of this sounds like where you're at right now, reach out. Drop me a message, give me a call, send me a text. We'll sit down, pull the actual numbers for the neighborhoods that you're looking at, and you'll walk away knowing exactly where you stand. No pressure, just clarity. That's what I'm here for. Real quick before you go, if you're trying to figure out whether now is the right time to make a move in Buckeye, Goodyear, or anywhere in the Southwest Valley, I've got a video that goes deeper on affordability of new construction communities, specifically the infrastructure taxes you should be aware of. I'll link it in the description. And if you found this video helpful, share it with someone who's been sitting on the fence about timing their move, because timing is everything. I'll see you on the next one.